I don't think that central bank accumulation of gold is relevant. I'm not saying it has no effect. It affects the gold price because it's another buyer, but I don't think that central banks will be able to save any of their currencies by accumulating gold. And the example I just keep going back to is Turkey. Turkey has been the biggest buyer of gold. So the Turkish central bank they're up and down, but like lately, I think over the past 2 quarters, they've accumulated a lot of gold. If you look at their gold reserves, but their currency is still on a hyperinflationary path. It keeps going. The value of it keeps going down and down and down. At the point where you see this in countries that have already reached hyperinflation. I think we talked about this before. That why does hyperinflation take so long? It's because, like, imagine you're in a car and you have the gas floored and the brake floored at the same time. Right? So if we're in a dollar system, then the dollar, it's the fact that you can still use dollars and the central bank can peg at an artificial price to the dollar and cause shortages in its country by doing that. So people will end up in breadlines. So you can put a brake on your currency by using dollars instead, and then what you see is like a diagonal in the value of the currency as it wants to go up, it wants to go down versus the dollar, but the central bank keep pushing it down, like artificially, and causing shortages. So that's where Turkey is. If you look at the currency, the Turkish lira, right? It's on a diagonal. It keeps going up, meaning going down, against the dollar every day on the same curve. It's been doing this for like 4 or 5 years. And you'll see the same thing in Argentina, except when Milei was elected, like it devalued a little, suddenly, and then went back on that same diagonal, but the same break. So what my point is, at the end of all this, is that central banks can accumulate as much gold as they want. Nobody trusts them anymore. So if you're not going to openly say, I have this much gold, central bank X says, I have 1,000 tons of gold. Now everyone with my liability units can get this much gold if they want. Here's the window. Come at 5 o'clock and we'll give you gold for whatever currency units you have. No central bank is going to do that. The only reason they buy gold is to sell it to save their currencies, and so it won't save any of their currencies. So whatever they're doing with gold doesn't matter. It's not going to save anything. There's not going to be a currency system. Currency is a derivative. There will be a currency system again, right? I don't know exactly how it's going to form, but in the immediate aftermath, you're not going to have currency. You're going to have money. Like, if we just take this down of several levels, right? If you have a credit card and you don't pay your bill, then the credit card stops giving you money and you can't use your credit card anymore. You can only live within your means. You cannot borrow anymore. It will not let you. Your credit card will not work. Even if it has a whole bunch of dollars on it, if the dollars, which are credit, are worthless, then it doesn't matter. So initially there won't be currency and it won't be barter. I mean, there's no qualitative difference between barter and money. The only difference is that money is a more liquid commodity. Barter is trading one good for another good. Well, so is money, because gold is a good and or silver is a good and you're trading it for other goods. That's barter. I mean, one's barter, the other's barter. The only difference is that one is a more liquid commodity. You can use it and you can divide it and you can trade it, around to different people, but it's barter. So I anticipate barter with gold and silver, which is just money, no credit, just money. And then eventually, when enough people accumulate enough money, they might be able to get together and say, hey, let's make a credit union, right? Then you start over. And hopefully it's decentralized this time. And then the credit unions compete based on the value of their credit. And then you have a free market of credit, which is what banks should be. The whole Keynesian system is dependent on higher interest rates. It means you strengthen the currency, means you slow down inflation. Like the way Walter Block, I remember, puts it, he says, Professor Walter Block of Loyola University, he's in the Mises Institute, or he was. He says that Keynesians believe the economy is like a car, right? You hit the brakes by raising interest rates and you hit the gas by lowering interest rates. So that works as long as the main owner of your bonds, of your government's bonds, is not the central bank itself. So if let's say the main holders of the government's debt are private companies or just anyone but the central bank. So if you raise interest rates, that would strengthen the currency, all other things being equal, because higher interest rates means higher savings rates, so that encourages people to save and spend less. If you encourage us to spend less, that means prices will go down, because the demand for holding money itself, as opposed to spending money and getting rid of it for other things, goes up. So in that situation, you're strengthening your currency, you're raising interest rates, you're hitting the brake on the car. But in a situation like Japan, it's the inverse. Why is it the inverse? Because the biggest owner of Japanese government bonds is the central bank itself. So therefore, when you raise interest rates, what happens to the central bank? Its balance sheet loses value, because when you raise interest rates, you're pushing down the value of the bonds, and therefore your central bank goes into losses. But the currency is the liability unit of the central bank itself. So at that point, where Japan is right now, the higher interest rates go, the lower the yen goes. You can see this on a chart going back like 5 or 6 years from the point where the inflection point started. The yen has been falling as Japanese interest rates have risen. Not perfectly. It's not perfectly correlated, because you still have people and traders that are human that still believe in the Keynesian principle, but nature overwhelms it. So what I'm saying is Japan can raise interest rates and therefore hurt its currency, because the biggest owner of the bond market is the issuer of the currency itself. Or it can push interest rates down and hurt its currency even worse. There's no way up for it. It's over. It's done for Japan. It's just a matter of time now.
What is happening right now in the global monetary system is precisely what Austrian economists warned about for over a century. People often ask me, Rafi, what exactly triggers the end of a currency system? What is the moment where everything flips, not gradually, but all at once? And the truth is that underneath the surface, underneath the headlines and the noise, currencies die because people stop trusting the issuers. They don't die because of a lack of yuan or yen or dollars. They die because the belief that these currency units can maintain purchasing power collapses. Today, we are watching that collapse unfold in real time. And the strange part is how few people understand what they're actually looking at. Let's start with something people bring up constantly. Rafi, the central banks are accumulating gold. Isn't that bullish? Doesn't that mean they're preparing to back their currencies again with something sound? And my answer is always the same. Central bank gold accumulation has some effect, but it's not the effect people imagine. It does support prices mechanically, because buying is buying. But in terms of saving their currencies, absolutely not. They could buy every ounce above ground and still fail to save their currencies for one simple reason. Trust has collapsed and nobody believes them anymore. Look at Turkey. Turkey is the real-time case study of what happens when a central bank buys gold, but refuses to allow its currency to float freely or to redeem its liabilities in actual metal. Turkey has been one of the biggest net buyers of gold for several quarters in a row. They bought tens of tons. And what did the lira do? It continued losing purchasing power every day in this slow-motion diagonal collapse against the dollar. That's what happens when you use your gold accumulation as a symbolic gesture rather than actually opening a redemption window. If the Turkish central bank came out tomorrow and said, "We officially guarantee our currency units with X grams of gold. Line up at the window and redeem at 5 p.m., their currency would stabilize. But they won't. Nobody will. Because central banks don't accumulate gold to give it away. They accumulate it so they can sell it later, trying in vain to stop a currency collapse. That's been the pattern for 100 years. The currency system we live in is a derivative system. The currency is not money. It is a claim on money. It's a claim on the balance sheet of a central bank. Just like your credit card balance is a claim on the bank that issued it. If you max out your card and stop paying, that card will eventually stop working. And if a central bank maxes out its balance sheet and destroys faith in its liability units, the currency will eventually stop functioning even if the paper still exists, and even if there are still numbers in your account. That's the world we're entering. This is why I keep saying that hyperinflation is not a straight vertical line. It stretches over time. It's not instantaneous. It has the staircase pattern, or more accurately, the diagonal decline that looks almost orderly, because the currency issuer applies the brakes artificially the entire way down. Think about Argentina. Think about Turkey. It's like pushing a car down a hill with one foot on the gas and one foot on the brake. So the currency doesn't collapse vertically, it collapses diagonally, but always on the exact same slope. And that slope keeps steepening with each intervention. You get a few moments of acceleration when the peg breaks, followed by periods of artificial suppression, and then the slope resumes. This is the path of every currency that's heading towards zero. Japan is the most important example right now because they're at the point where the Keynesian textbook doesn't work anymore. Keynesians still maintain this view that raising interest rates strengthens a currency and lowering rates weakens it. That's true only in one specific condition, when the central bank itself is not the primary buyer of its government's bonds. Because in that system, higher interest rates attract savers, attract buyers, strengthen the currency, slow spending, and reduce inflationary pressure.
Few things that I'm tracking. I always track the plumbing first, and then I see if it's affecting other things. So what I mean by the plumbing, those who have followed me probably know what I'm talking about. The interest rate that is the basis of all other interest rates, that's the secured overnight financing rate, the rate at which banks charge each other to loan cash in exchange for treasuries overnight. That's it's heading higher and higher and high. It's drifting higher, even higher on some days than the Fed's upper limit on the Fed funds rate. The Fed funds rate is like a different thing. It's a very minor market. It doesn't even matter anymore. It's like the volume there is like $100 billion a day at most, whereas the secured overnight financing market is like over $3 trillion. So the largest volume has been 3.2 trillion. And it keeps going up, the volume, which means more and more and more banks need money overnight for whatever reasons it is. I mean, it's probably a lot of the bank's clients are engaged in some kind of basis trade on whatever treasuries, and it keeps getting bigger and bigger. They can't provide the dollars, then those trades have to close. The Fed is in a bind now. Because eventually this is going to lock up pretty soon. I thought it was going to lock up already because there's less than $3.2 trillion in bank reserves out there, but apparently you can go above that. I don't know how much farther you can go above it, but at this point, last time we already had locked up in 2019, and then from there came the expansion of the balance sheet, and then from there, a few months later, was the COVID printing round. And now you could see that as a separate phenomenon or a coincidence that they had an excuse to print like $4 or $5 trillion just a few months after the plumbing locked up. Or you could take a more conspiratorial angle and say it was planned, or they just had an excuse and they went with it. Whatever it is, I mean, they needed to print the money. Ever since then, from then until around now, there were no more repos provided by the Fed. I mean, repos provided by the Fed is when banks don't have enough cash to lend to each other, so the Fed has to step in and say, you know what, we'll provide the missing cash. So that was the case from about maybe like 2014 to 2019, like after QE3 ended, and they started shrinking their balance sheet for the first time. So there were repos in those years until 2019, and they stopped. Then they started again after the repocalypse, and then they stopped during the COVID printing until now. So now the Fed is providing repos again, not that much. And I just read an article on Bloomberg that there was an emergency meeting or a sideline meeting between John Williams, head of the New York Fed, and a whole bunch of representatives from different banks as to why they weren't utilizing the repo facility more. That because what they're doing is their banks are borrowing at higher rates from other banks than the Fed is offering on repo. And then John Williams is like, why are you doing that? Why are you paying more when you could just come to me and I'll give you the cash? And they're like, basically, well, it looks bad if we do that, and we don't want to come to daddy, for money, because then it makes us look really weak, and then other banks charge us higher interest rates because they don't trust us. So the only way they can make the repo facility more attractive is by forcing everyone to use it, so everyone's on an equal playing field. I think they'll probably try to do that.
When you look at where we are right now, the first thing to understand is that the global monetary system has already crossed a threshold. The process is not beginning. It began years ago. What is happening now is acceleration. And the clearest place to see this acceleration is in Japan, where the carry trade has entered its end phase. For decades, the world borrowed yen at 0% and used those borrowed yen to buy everything else: US stocks, emerging markets, crypto, European bonds, corporate debt. You name it. It was the cheapest money on earth. And when you subsidize something artificially for nearly 30 years, you distort every price in the global system. Now the distortion is unwinding. Japan raised interest rates, their yield curve has steepened, and the yen has strengthened off its lows. That might not sound dramatic until you realize the scale. This is the biggest arbitrage trade in the history of global finance. You are talking about trillions of dollars borrowed in yen. And the moment the yen stops weakening, or worse, begins rising, the math breaks for everyone on the other side of the trade. To unwind, you must buy yen. But to buy yen, you must sell the assets you bought with borrowed yen. That means selling US treasuries, selling stocks, selling crypto, selling emerging market debt. And selling at size always crashes prices. Japan holds roughly $1.1 trillion of US treasuries. Pension funds, insurers, corporations, massive institutions built long-term investment portfolios on the assumption that the yen would weaken forever. That assumption is gone, and now to prevent their balance sheets from imploding, they must repatriate capital, which means selling treasuries, which means higher yields, which means bond price losses everywhere, which then feed back into the portfolios of Western banks that were already struggling from duration losses in their bond books. This is why the US Federal Reserve keeps talking about how they lowered rates, but the 10-year yield refuses to fall. It's not because the Fed is losing control of the short end of the curve. It's because foreign demand for treasuries is evaporating and large buyers are turning into sellers. When your largest external creditor becomes a forced seller, your long end cannot fall. This is why the Treasury keeps having disastrous auctions. There is no bid. Every leveraged trader, every hedge fund, every institution that borrowed cheap yen for yield is now facing margin calls. And once margin calls begin, selling becomes reflexive, it becomes mechanical. There is no choice. It's not about sentiment or belief, it's about collateral and risk calculations. This is why I keep saying the carry trade is not some isolated technical issue. It is the global financial system's spinal cord. It was the subsidy that kept everything inflated. And now the subsidy is dying. This is precisely the moment where you would expect gold and silver to behave exactly as they are behaving, by breaking correlations, by rising even when the risk on assets fall, by moving independently of liquidity cycles. This is what happens when a monetary transition begins. First, the central banks buy, then the wholesale market buys, then long-term institutional allocators buy. And at the very end, the public buys. We are not at the public stage, not even close. Think about the data. Gold has outperformed the treasury market for 25 years. That's not a short trend. That's an entire generational cycle. If you price the S&P 500 in gold ounces, not dollars, the US stock market has gone nowhere since the year 2000. 25 years of sideways movement. Yet almost nobody sees this because they only look through the lens of a deteriorating denominator. Gold has beaten the S&P with dividends reinvested. It has beaten the 10-year yield. It has beaten bonds, cash, real estate when measured in liquidity-adjusted terms, and it has done so quietly without fanfare, without the mainstream financial industry acknowledging it. Even now, with gold up 60% last year and another 60% this year, the public is barely involved. What is really driving the gold market today is not the retail investor. It's not the 60-40 advisor. It's not the casual speculator. It's the central banks, the sovereign wealth funds, the commercial banks, and the very largest allocators of capital in the world. It is the traders on the COMEX who are actually taking delivery. It is the sovereign entities pulling metal off the LBMA month after month, draining Western vaults. It is the Eastern world building storage facilities, refineries, and conversion hubs designed specifically to handle gold outside the dollar system. And this brings me to something critical: the fracture between the paper markets and the physical markets. The COMEX futures market and the LBMA spot market were designed for a world where most participants settle in cash. That world is gone. Now you have large entities standing for delivery, asking for real metal, not paper, and they are doing it at increasing scale. This is why backwardation matters. When the near-month contract trades above the deferred months, It tells you that the market values physical metal more than promises of future metal. That is not normal in a healthy market. Backwardation in gold is extremely rare. Backwardation in silver, prolonged backwardation, is a major signal. It means the market believes the immediate good is more valuable than the future promise. That only happens when shortages exist or when trust in future performance disappears. The last time we saw this dynamic develop meaningfully was in 2008. During the crash, the paper price of gold fell from $1,000 to $700. Silver fell from $21 to $9. And yet, not a single ounce of physical was available. The US Mint shut down multiple times. The Perth Mint in Australia ran out of product and refused new orders. The Rand Mint in South Africa was wiped out. Major European mints were operating 24 hours a day and still had 12 to 14-week delays. Dealers paid double-digit premiums over spot to get any inventory at all. That was during a temporary paper smash. Today, shortages are emerging before the price correction, not after. That is the difference. Today, we have backwardation while the price is rising. Delivery demands are rising while the exchange inventories are falling. SLV's short interest exploded. The borrow rates to short silver have skyrocketed. The lease rates have spiked. Everything points to the same structural tension. The physical market has taken over. This is why the old model, where the paper market wagged the physical dog, is breaking. You cannot print physical metal. You can mint contracts, but when the market stops believing in those contracts, only metal settles the argument. Now combine this with what's happening in COMEX delivery months. December is always the big month. Traders roll or stand for delivery. If they roll, you stay in the derivative world. If they stand, you enter the physical world. And this year, standing for delivery is overwhelming rolling behavior. That is an existential threat to the exchanges because if too many stand, the metal is not there. This is the point where a paper market can fail.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.